Tonight is New Year's Eve, 2025. While you're popping champagne in New York, London, or Toronto, waiting for the ball to drop, something historic and potentially catastrophic is happening in Eastern Europe. In less than 24 hours, the Bulgarian Lev, a currency that has survived the fall of communism and the chaos of the 90s, will cease to exist. On January 1st, Bulgaria officially adopts the euro. It becomes the 21st member of the Eurozone. On paper, this sounds like a victory lap. The European Central Bank in Frankfurt is lighting up its skyscrapers in celebration. The blue flag with the gold stars is plastered on every government building in Sofia. But look closer. This isn't a celebration. It's a crime scene. The government that pushed for this transition? They just resigned. Gone. The national budget for the upcoming year? It doesn't exist. The streets? They are filled with protesters who claim the political elite are looting the country one last time before the currency switch covers their tracks. We are looking at a nation attempting to integrate into the world's second largest reserve currency while having no functioning government, a population that has shrunk by 16%, and an oligarchy accused of running the state like a mafia fiefdom. Why should you care if you live in Ohio or Ontario? Because the last time the EU let a politically unstable economy with cooked books into the club, we got the Greek debt crisis of 2010. That crisis nearly destroyed the euro, sent shockwaves through the NYSE, and decimated 401(k)s across America. Is history repeating itself? Is the Eurozone absorbing a Trojan horse? And what happens to the value of the dollar in your pocket if the euro takes a massive hit in 2026? Tonight, we are peeling back the layers of the Bulgarian experiment. This is the story of money, power, and the invisible lines that connect a riot in the Balkans to your stock portfolio. Welcome to the channel. Let's dive in. To understand the risk, you have to look at the political vacuum. Imagine if, in the United States, the president resigned, Congress went home without passing a budget, and nobody knew who was actually in charge, all while the Federal Reserve was replacing the US dollar with a new currency. That is the reality in Bulgaria right now. As of mid-December 2025, the Prime Minister has quit. The political parties are gearing up for what looks like their 8th election in 5 years. Let that sink in. 8 elections. In the UK, you get fatigued after 2. In the US, we can barely handle 1 every 4 years. In Bulgaria, democracy has become a revolving door that spins so fast nobody can actually step inside to govern. The catalyst for this latest collapse wasn't just political bickering. It was rage. In November, protests against proposed tax hikes and spending plans turned into the most violent unrest the country has seen in over a decade. We're talking about a level of public anger that makes regular political discourse look like a tea party. Ivan Peeve, a 34-year-old technical support worker in Sofia, put it bluntly to reporters this week. He said, "Every cent you give to this government is going to be stolen." It has never been so visible. This isn't just one guy venting. This is the sentiment of half the nation. Polls show the country is split right down the middle on the euro. Why? Because they don't trust the people counting the money. The European Union has spent years criticizing Bulgaria for its rule of law failures. In plain English, that means their judicial system is broken, and their politicians are untouchable. Yet, come January 1st, the ECB is handing the keys to the euro printing press to a country that effectively has no driver at the wheel. Goran Georgiev, a senior analyst at the Center for the Study of Democracy, calls the current situation a paradox. The pro-EU parties in Bulgaria use their connections in Brussels as external validation and whitewashing. Basically, as long as they wave the EU flag, Brussels looks the other way while they dismantle the state from the inside. This is the definition of moral hazard. And for investors watching the euro, this is a massive red flag. Stability is the currency of markets. Bulgaria offers none. Now, let's play devil's advocate. If the politics are such a dumpster fire, why did the European Central Bank give the green light? Because, on the surface, the numbers look fantastic. If you pull up the Bloomberg terminal and look at Bulgaria's macro stats, you'd think it was the Switzerland of the Balkans. GDP quadrupled to $110 billion since joining the EU in 2007. Wages growing faster than anywhere else in the 27-member bloc. Debt to GDP ratio, less than 30%. To put that in perspective, the US debt to GDP ratio is over 120%. Japan's is over 260%. Even Germany is struggling to keep theirs down. Bulgaria at 30% sounds like fiscal heaven. But here is where you need to be very, very careful with statistics. In finance, we have a saying, profit is an opinion, cash is a fact. In national economics, low debt is sometimes just a sign of neglect. Why is the debt so low? Partly because the government fails to invest in anything. Infrastructure, healthcare, education, these sectors are starving. When you have a revolving door of governments, no long-term projects get approved. You don't borrow money to build bridges if you aren't going to be in office long enough to cut the ribbon. Furthermore, the wealth gap is staggering. Bulgaria has the highest income inequality in the entire European Union. The average wage in Sofia is double what people make in the northeast regions. It's a tale of two cities on a national scale. While Ivan Peeve in tech support has seen his salary double since COVID, millions of others are being left behind. Per capita GDP is still the lowest in the EU, at just 66% of the average. Neighboring Romania, which joined the EU at the same time, is at 77%. Romania is leaving Bulgaria in the dust. So, we have a clean balance sheet masking a hollowed-out economy. This is eerily similar to the setup before the Greek crisis. The numbers satisfied the Maastricht criteria, but the underlying structure was rotting. And there is another ghost haunting this machine, the 1990s. Older Bulgarians remember hyperinflation. They remember life savings being wiped out overnight. They are terrified that retailers are going to use the switch to the euro as an excuse to jack up prices. And they are probably right. The government just announced sanctions on December 29 against retailers for unjustified price increases. When a government has to threaten shopkeepers with sanctions 2 days before a currency launch, that is not confidence. That is panic control. You cannot talk about Bulgaria without talking about the oligarch problem. This is the variable that doesn't show up on a spreadsheet, but it's the one that determines who actually wins and loses. In the US, we worry about lobbying. In Bulgaria, they worry about state capture. This is a situation where private interests oligarchs have effectively purchased the decision-making apparatus of the government. Let's introduce two key players who have been dominating the headlines, Boyko Borisov and Delian Peevski. Boyko Borisov is the former prime minister whose party, GERB, dominated for years. Then there's Delian Peevski. Protesters call him the eminence grise, the Grey Cardinal, the power behind the throne. He's a media mogul and politician who has become the lightning rod for public rage. In 2013, tens of thousands flooded the streets just to stop Peevski from leading the National Security Agency. In 2020, massive protests erupted again, accusing Borisov and the chief prosecutor of running a protection racket for the elite. Despite dozens of probes, despite the US and UK sanctioning individuals under the Magnitsky Act in the past, and despite the EU blocking recovery funds due to a lack of anti-corruption reforms, nobody at the top has been charged. Both men deny any wrongdoing. But the perception among the public and international watchdogs like Transparency International is that the game is rigged. Bulgaria ranks just above Hungary as the most corrupt member of the EU. Here is the wallet connection for you. When a country joins the euro, it gains access to the European Stability Mechanism and deeper liquidity pools. If that money is funneled into crony contracts instead of productive economic growth, it creates a bubble. When that bubble pops, it's not just Bulgarian taxpayers on the hook. It's the ECB. It's the euro. And if the euro destabilizes, the US dollar spikes in value. Wait, you say, isn't a strong dollar good? Not if you own US stocks. A super strong dollar crushes the earnings of multinational companies like Apple, Coca-Cola, and Ford, because their overseas profits are worth less when converted back to dollars. A corruption scandal in Sofia eventually shows up as a missed earnings report on Wall Street. It's the butterfly effect of global finance. There is a long-term economic force at play here that is even more dangerous than corruption: demographics. Since joining the EU in 2007, Bulgaria has lost 16% of its population. More than 1 million people have packed their bags and left. This is one of the fastest population drops in the world. Elena Ivanova, a 32-year-old stay-at-home mom protesting in Sofia, told reporters, "Many of my friends left Bulgaria. I want my sons to remain." She is fighting a losing battle against math. The EU is built on the 4 freedoms, one of which is the freedom of movement. It's a beautiful idea. But for a poorer nation like Bulgaria, it acts as a vacuum cleaner for talent. The smartest, most ambitious, and most productive workers move to Germany, France, or the UK to earn triple the wages. Who is left behind? The elderly. The pensioners. And a shrinking tax base trying to support them. This creates a vicious cycle. 1. Young people leave because of corruption and low wages. 2. The tax base shrinks. 3. The government has less money for services, or has to raise taxes. 4. Life gets harder, so more people leave. This is the Rust Belt effect, but applied to an entire sovereign nation. Now, lock that nation into a currency they cannot devalue. Usually, if a country becomes uncompetitive, it can devalue its currency to make its exports cheaper. Bulgaria is giving up that tool tomorrow. They are burning the lifeboats. If their economy stalls due to a labor shortage, they cannot print their way out of it. They will have to undergo internal devaluation, which is economists speak for cutting wages and firing people. That is exactly what happened to Greece. And we know how that movie ends. We have to address the elephant in the room. Or rather, the bear in the room. Russia. Bulgaria has historically had deep ties to Russia. And right now, the political landscape is a battleground between pro-Western reformists and pro-Moscow nationalists. President Rumen Radev is widely considered Russia-friendly. He, along with the Nationalist Revival Party, actually pushed for a referendum to block the euro adoption. They failed, but their influence is massive. As the government collapses and 40% of Bulgarians say they want a brand new political savior, eyes are turning to Radev. If he launches his own political movement, he could sweep the board. Here is the geopolitical nightmare scenario. Imagine a country that is a full voting member of the Eurozone, holding a seat at the ECB table, but its government is ideologically aligned with Moscow. In an era where the West is trying to maintain sanctions and a united front against Russia, Bulgaria could become the weak link. A Trojan horse inside the fortress of the European economy. If Bulgaria starts vetoing EU financial aid, or if they leak sensitive financial data, or if they simply cause gridlock during a crisis, the stability of the entire bloc is compromised. For the US and UK, this is a security risk. For investors, it's a volatility risk. Markets hate uncertainty. And Bulgaria is introducing a massive variable of uncertainty into the heart of Europe's financial system. So, what happens next? As we look into 2026, let's game out the scenarios. Scenario A, the golden handcuffs. This is what Brussels is hoping for. The argument is that the euro acts as a golden handcuff. By adopting the euro, Bulgaria is forced to follow stricter fiscal rules. They can no longer print money to cover up corruption. The oversight from the ECB forces the oligarchs to clean up their act or starve. Foreign investment floods in because the currency risk is gone. Tourism booms. The Silicon Valley of the Balkans narrative becomes reality. Probability, 30%. Scenario B, the stagnation trap. Bulgaria becomes the Italy of the East, but without the Ferraris and Prada. Permanent political gridlock. Low growth. High corruption. They survive on EU handouts, but the young people keep leaving. It's not an explosion, but a slow, painful decline. Probability, 50%. Scenario C, the Balkans spring. The price hikes in January 2026 trigger a snapping point. The unjustified price increases the government warned about become rampant. Inflation spikes. The protests we saw in November return, but this time they don't stop. The government fails to form. President Radev steps in with a populist, pro-Russian platform. The EU threatens to cut off funding. Bond yields spike. Probability, 20%. For the average Bulgarian, like the psychology student Irina Staneva who told reporters, it's the feeling that someone has taken away something that partly belongs to me. Scenario C is the biggest fear. They feel like their future is being stolen in real time. So, here is the bottom line for you, watching from the safety of your home office. Tomorrow, January 1st, 2026, is a historic day. But do not mistake the fireworks in Frankfurt for a signal that everything is fine. The European Union is expanding its currency into a region defined by instability, corruption, and demographic collapse. They are betting that the magic of the market will civilize the Wild West of the Balkans. If they are right, Eastern Europe could become the next great emerging market growth story. If they are wrong, we are looking at the first cracks in the next Eurozone crisis. Here is my advice. 1. Watch the euro to US dollar pair. If you see the euro start to slide in Q1 2026, it might be the market pricing in this Bulgarian contagion. 2. Keep an eye on European bank stocks. They are the ones holding the debt. If Bulgaria wobbles, those banks take the hit first. 3. Understand the dollar smile. If Europe gets messy, capital flees to safety. That means the US dollar rips higher. Great for your vacation to Paris, bad for your US tech stocks with international exposure. The world is interconnected. A resigned government in Sofia can ripple through to a trading desk in Chicago. History doesn't always repeat, but it often rhymes. And right now, the rhyme scheme looks a lot like 2010. Stay liquid, stay skeptical, and I'll see you in the next one.